Hello everybody, I'm John, this is JP Strategic Investments, and today I want to talk about the new documents that were released on Patriot One Technologies investor relations page late last week. And the main one here, the preliminary short form base shelf prospectus. Now, first of all, the thing I want to mention right off the bat, and a lot of people pointed this out already in different investment groups and things like that, this is just a plan. Okay, this isn't saying we are going to do this, we're raising $50 million and there's going to be a huge amount of dilution. This is just them preparing, which by the way I think is a very prudent thing to do for what could be a likely scenario where they have to raise money. And the reason I say it's a very prudent thing to do is because you don't want to get to a point where 2-3 quarters from now where you're like, all right, next quarter, it looks like we didn't get enough contracts and we're going to have to raise money. All right, let's come up with a plan to raise money. You don't want to do that. You don't want to do a last minute, thrown together plan to raise money. You want to have this in the works already, kind of a plan B, if you want to call it that, and have it ready and available and already kind of put together and worked out so that if you do need to go for it, it's ready, it's organized, it's thought through, and you can go about it in the right way. So I just wanted to kind of mention that right off the bat, make sure you guys all understand that. This isn't something that is necessarily set in stone. There's going to be, as they have said, amendments to this prospectus as well. This is them kind of just laying the groundwork, getting the process started for any sort of capital raise or anything like that if that becomes necessary. Now, as I said in my last earnings video for Patriot One, it does look more and more so like this is a very likely possibility that they will have to raise money. How much money is more so the question. I mean, if we look at their last earnings report, we saw they have about $9 million left in cash, and that was as of July. So now we've had the first quarter that pretty much ended yesterday, right? August, September, October, right? That's the first quarter. If cash burn was relatively the same, unless there's been any major changes, we're probably seeing another close to $3 million burned from that cash reserve. So now we're probably looking closer to $6 million. Have about 2 quarters left. It's looking more and more like we're going to have to raise money here. And so it just depends on how they want to do that, and they've kind of laid out some options here. So I want to go through these different options: the common shares, warrants, subscription receipts, units, and debt securities. Kind of walk you guys through each one of them. I know a lot of you probably understand all or at least some of them, but some of you guys may not have heard of warrants or units or things like that. And so I just want to go over them, and then I'm going to give my thoughts on kind of what I think the best way for them to do this, if they were to do this, is, and then obviously in the comments I'd love to hear what you guys think of how they should do this and anything related to this. So let me just jump right into it. The first one, common shares, that's just shares, right? Offering more shares. We all understand what that is. They would just be kind of standard dilution. The more shares you add, the less of a portion of the company that a share makes up, and so all current shareholders, their shares would be diluted. So if they were to raise the entire 50 million, which again there's no guarantee that they will, if they were to raise the entire 50 million, right, the current Canadian market cap I think is somewhere just under 70 million. So that would be a pretty high dilution ratio, about 70% or so, something around there. So that is common shares. Now warrants are a little bit like options. If you guys understand options, especially call options, it'll be pretty easy for you guys to understand what a warrant is. Basically what a warrant is a warrant is like a call option in that it gives you the right to purchase shares in the future, but one warrant is equal to 1 share. It's not like a call option where you control 100 shares with the single option. It's just basically 1 warrant per share. And so, for example, you might pay, or Patriot One might offer a warrant for a strike price of, let's say, 60 cents per share at a price or a premium of 10 cents. And so just to kind of lay that out for you, what that would mean is you as an investor or an investment bank or whoever's buying these warrants would pay 10 cents, and basically that would give them the right to purchase one share of Patriot One at some time in the future. And usually it's an amount of years, right? So maybe 3 years or 2 years, or they can even go out to as much as 15 years, I believe, on warrants. So it gives you the right to purchase those shares basically within a certain time period, right? And so what happens is if the stock gets above that strike price, right, of 60 cents per share, then you're able to buy shares at 60 cents even though they may be currently worth, 80 cents or $1, right? And so you get a pretty good profit on those shares, and it only costs you 10 cents per share, so you're risking a lot less. Now, if the stock doesn't get above 60 cents, or actually really if the stock doesn't get above 70 cents because you paid a 10-cent premium, then you would lose money. You'd possibly lose all of your 10 cents if it doesn't get above 60 cents per share. Now, from the company's standpoint, this is pretty good because it doesn't actually dilute any shares unless the share price is appreciated at least above whatever the strike price is. And usually the strike prices are pretty significantly above what the current, where the stock is currently trading at, right? So dilution would only happen if the stock price has appreciated. And also the company only has to pay out the shares, right, if the stock price is appreciated. So even if the stock price appreciates a little bit, if it doesn't get above the strike price, the company actually doesn't even have to pay back the share. It doesn't have to issue the share, so it really costs the company nothing. And also from a shareholder's point of view, if they were to offer these warrants to retail investors, if these were available for regular investors to buy, this would give us a chance to kind of purchase some of these warrants and protect ourselves from a little dilution, while at the same time almost being able to buy some call options essentially on the stock. So being able to benefit even more from future appreciation of the stock, and also protect at the same time against some dilutive effects there of the stock. So that's kind of how warrants work. So I know that's a lot to take in. For those of you that don't understand call options, it's probably a little bit confusing, but if you do understand options, or if you go check out some videos on options, you'll probably get a much better idea of exactly how a warrant works. And so that's kind of what this would probably look like in the sense if they offered warrants. Subscription receipts, this is the only one where I'm kind of a little bit unsure of exactly whether what I'm thinking of is what they are offering, because they're using a little bit different of a name than what I've seen before. So what I think this is a subscription receipt. I think it's like subscription rights, and basically how those work is if a company is going to do a secondary offering of shares, so if they were to just offer common shares, a lot of times what they will do is they will allow current shareholders to purchase more shares. So it might be like if you own, for every 2 shares you own, you can buy 1 more share, right? So for example, if the stock, we'll just use the Canadian price for example, Canadian price, the stock is trading at about 44-45 cents a share. Maybe they say for every 2 shares you own, or for every 3 shares that you own, you have the option to purchase another share at, let's say, 30 cents or 35 cents per share. So you do get a slight discount. You're able to protect yourself a little bit from the future dilution because they are going to offer a certain amount of shares. And so in that way, they're able to offer their current shareholders some protection against the dilutive effects of offering or a secondary offering of shares. So that is subscription receipts, or that's what I think they mean with subscription receipts. If any of you guys have heard anything differently or know specifically about subscription receipts, definitely leave that in the comments below and let me know if you think I'm mixing anything up there. But I think it's going to be the same thing or fairly similar to subscription rights, which is what I just described. Now units are kind of basically they could be a little bit of everything. So a unit could be a combination of a variety of different types of securities. So if you buy one unit may be the equivalent of 100 shares, 50 warrants, and 20 subscription receipts, or some sort of combination like that. It really just depends on how the company wants to structure it, how they want to offer it. But basically, a unit is usually a combination of other types of securities. And the last one here we have is debt securities, which there's a couple different ways this could be done. This honestly could just refer to a loan, right, where they borrow a certain amount from the bank, or you could have some sort of like convertible debt here where basically Patriot would take a loan of X amount of money, let's say $1 million or $2 million, and essentially say, hey, if our stock price is above 50 cents a share or 60 cents a share or something by the time that the debt is due, whether that's like a year or 2 years or however many years that is, then instead of paying off the debt, Patriot One can just issue however many shares would make up that amount of debt to whoever they took the loan from, whether it be an investment bank or some other type of bank or something like that. So that's an advantage because if the share price is able to appreciate, if Patriot One does well, uses that money wisely and gets more sales, then instead of actually having to pay off that debt, they can just issue more shares, which will have a dilutive effect, but it will allow them to keep a lot of cash, which will make the company, more valuable. So it can kind of counteract that dilutive effect there. So those are kind of the different things that Patriot One could do. That's what they've kind of laid out here with common shares, warrants, subscription receipts, units, and debt securities. Now, as far as what I think would be the best way for the company to go about doing this, I think they should honestly use a combination of most of these. I think for the most part, the avenue that offers the least benefit to current shareholders is if they were to just issue current shares, because that would have the most dilutive effect right off the bat. It would, though, probably allow them to raise the money the quickest or the fastest, right? Because they would be able to get more per share, right? If they were to sell warrants or subscription receipts or combine any of those into units, they're probably going to get less per share that they issue rather than just issuing common shares. Now, if they issue warrants or subscription receipts or any combination of those with units, that would probably be the most beneficial to current shareholders and possibly the company as well, depending on where the stock price goes. It would be the most beneficial to current shareholders because it offers both of those warrants and subscription receipts do offer some safeguards against some of the dilutive effects of that type of capital raise, and it allows shareholders to either get a discount on shares or essentially get call options with the warrants on Patriot One, which many shareholders, myself included, probably would want to take advantage of. And finally, debt securities, that definitely is an option as well, depending on what they can negotiate with the terms as far as when the debt will be able to be converted, at what price, and kind of the interest rate on that debt. So that kind of more so depends on the terms there, which a lot of them kind of do. But in my opinion, probably the best way to do this is kind of a combination of warrants, subscriptions, and maybe some convertible debt there, and you could wrap that in together within units and things like that. I think the worst way to do this for current shareholders, which again is maybe the fastest way and might be necessary at least right off the bat. So anyway, those are my thoughts. That's kind of what I am looking at here and what I think would be kind of the most beneficial to current shareholders. Let me know what you guys think in the comments below. Let me know if you guys think I'm missing anything, what you think that the company should do here if they have to raise this money, and any other things that you think are relevant here. I'd love to hear what you guys think in the comments below. Other than that, I will see you guys next time, and have a great day.